Did you know that taxes could be your biggest expense in retirement? Not your mortgage, not healthcare, but taxes. But here's the good news. By understanding the tax location of your accounts, you can strategically minimize your tax burden and keep more of your hard-earned money. So today we're going to be breaking down the three main types of accounts that you can use for retirement. That includes taxable, tax-deferred, and tax-free. I'm also going to be discussing how they impact your income in retirement, how you can optimize these accounts to work in your favor. So first, let's talk about tax location. This is all about understanding which tax bucket your money lives in. So first is taxable accounts. These include things like your brokerage accounts, trust accounts, savings accounts, CDs, etc. The way it works is you're going to be paying taxes on dividends, interest, capital gains every single year. So for example, let's say you have $100,000 invested in a brokerage account and you earn $5,000 in interest or dividends. You're going to owe taxes on that $5,000 annually. Now, the pros to these accounts is it's flexible. You can access your money anytime. The cons are they are less tax efficient over time, especially if your income or gains are really high. But these accounts are great to have access to because they provide a lot of flexibility when you need them. Next is tax-deferred accounts. This is where most people save for retirement. Think 401ks, traditional IRAs, 403bs, and similar plans. You don't pay taxes today, but you get a tax deduction when you contribute. But you pay ordinary income tax when you withdraw in retirement. So for example, again, let's say you have $1 million in a traditional 401k, and when you take out $50,000, it's going to be taxed as ordinary income, just like your paychecks used to be taxed on. So the pros on these is, look, you save taxes today, the money grows tax deferred. The cons are you're going to be owing taxes later, and eventually you're going to have to start taking required distributions at age 73. So think of tax deferred like you're borrowing money from the IRS, but eventually they're going to want their share and they're going to be taxing you when you have the most money. And finally is tax-free accounts. These include things like Roth IRAs, Roth 401ks, and even health savings accounts. So when used properly, all of these can provide tax-free access. So when you contribute, you're putting after-tax money, except for HSAs, but you put after-tax money, your money grows tax-free, you can pull it out tax-free. So for example, you put in $100,000 and that money grows to $300,000, you can pull out all of the money 100% tax-free if you follow the IRS guidelines. So the cons for some of these accounts is they cap you on the amounts that you can actually put in, like a Roth IRA or a Roth 401k. But the benefits are used strategically. You can essentially funnel away a lot of your taxable and pre-tax accounts into the tax-free account. So these are amazing vehicles to have, all of them, the taxable accounts, tax-deferred, and tax-free accounts, because if you use these to your advantage and if you have a proper plan in place, you can really optimize your retirement income with all of the accounts, depending on whether tax rates are high or low or what have you. If you have the right plan and you have all three, you can really use all of them to your benefit. So let me walk you through a quick client case study so you can see what I'm talking about here. This is a sample client. This is Darren and Amber Henderson. Darren is 62, Amber is 64. Just a quick rundown. They have about $3.5 million of net worth. Majority of their assets are in their workplace 401ks. So Amber with a little over 1.1 here, Darren with 850 in his 401k, 200,000 in his Roth. He's got a Vegas account, as I like to call, some fund money where he invests $30,000. They own their home outright, and they have about $210,000 in cash. Some of their high-level goals, so they want to retire at age 65 and 67 respectively. They want to have an annual vacation where they're spending about $10,000 a year when they retire. They have a child that they want to prep for a potential wedding cost in the future, so they want to allocate $30,000 there. And they are anticipating some additional retirement healthcare costs later on in life. And so when we look at the Hendersons, the first thing we want to look at is their asset allocation. So where is their money allocated today? And right now, they're close to about a 50-50 portfolio, 50% of their portfolio in stocks and about another 50% in bonds and cash. But in order for them to reach their retirement goals, in order for them to achieve their aspirations, they actually have the need and risk capacity to have a more aggressive portfolio. So after an analysis, they actually need more of like a 70-30 split portfolio. So 70% in roughly equities and another 30% in bonds. And so their current tax location where all their assets are, so they currently have $240,000 in taxable accounts. They have another $1.975 million in tax deferred in their retirement accounts, and then only about $200,000 in tax-free accounts. So when we do tax planning, we want to take into account all of these different areas. And we know that in our lifetime, we are going to pay a significant amount of taxes with our pre-tax investments. So again, when we're looking at our pre-tax investments, these are your tax deferred, so traditional IRAs and 401ks. We also know that we are going to pay less amount in tax-free accounts. So I wanted to share with you a quick strategy on what some simple tax planning could do, and incorporating tax strategy with your asset location and asset withdrawal strategy, what this can do to your financial plan. So for example, if we focus on location and we look at your equity, we look at all your stocks, and instead of just allocating, so in their scenario, they need a 70-30 portfolio. So instead of just having 70-30 split in taxable, tax-deferred, and Roth, what we're gonna do, we're gonna be a little bit more strategic. We're gonna have a approach where we are going to put a significant amount of our stocks in our taxable bucket, only about 63% in tax deferred, and another 100% in tax free. And the reason for that is our non-dividend producing stocks and the stocks that are appreciating in value, we don't want to have less favorable tax treatment with those accounts. So we're going to choose to put them in taxable and essentially even tax-free accounts. And then on the income producing bonds that we have, we're going to put them in our tax deferred bucket. We're going to put them in the middle bucket there. We're assuming there's no municipal bonds here, which are tax-free. These are just regular corporate bonds. So just by doing this, so just by having a strategy where we're having this split, so again, 70-30%, so 100% of our stocks are going to be in our taxable accounts, only 63% in tax deferred, and then 100% in our tax free. By just doing this, we're adding an extra $530,000 into our ending assets and $223,000 less taxes paid, $804,000 in less withdrawals from tax deferred accounts. So again, just a powerful thing to do, just looking at a strategy for your asset location. Now, if we incorporate withdrawal strategy, so again, this is the sequence and the different accounts we're going to be using to pull out for retirement. If we take a similar approach and we pull from our taxable account first, then we go to our tax-free, then we go to our tax-deferred. Well, now we're looking at over $1.1 million in more adjusted ending assets, almost double the tax savings, $418,000 in less taxes paid. So just by having a strategy around your asset location and withdrawal strategy can mean for some people hundreds of thousands, if not millions of dollars of lost wealth that you're giving Uncle Sam, you're giving him this huge tip only because you didn't have a plan in place. This is how powerful tax planning can be in retirement. And if we want to get fancy, we can also pursue potential Roth conversion strategies. So there's going to be a time where you have a drop in your income. So what this chart is demonstrating is, let's say the blue here is when both Amber and Darren are going to be retired. So all of a sudden you see their income drop and they're in a really, really low tax bracket. And so during the years of 67 and essentially 73, This window where you see this green area here, this is where we could actually do some very strategic conversions, and we can convert money that's in the pre-tax retirement accounts like the 401ks and IRAs, and we can convert a portion every year because we're going to be at a lower tax bracket. So we'll pay the taxes at a very, very low bracket, convert the money, and now we have some tax-free money that's growing. And because of that, with this strategy, so again, having the asset location strategy with your equities, having a withdrawal strategy, the withdrawal sequence in which you're going to be pulling money when you retire, and doing strategic Roth conversions when your ordinary income drops. What this does to us is it's going to provide us with a little over $1.6 million more in ending assets versus if you have no plan, you do nothing at all. This is what's being left on the table. So in short, in summary, the bottom line is taxes matter, and you have to focus on how you can optimize your retirement plan and do it in a legal way by utilizing the tax code to your advantage. And at the end of the day, you can avoid the nasty surprises later if you do the legwork and if you get the proper review, because this can be really impactful. I mean, depending on how you structure your retirement income, you can either pay a lot of taxes, you could pay less taxes. But if you have a plan in place and you have a crystal ball, if you will, then you can really set your wealth plan up for success. So hopefully you got some value out of that. Feel free to subscribe and like the video. And if you want to learn more about me, you can check out our website, wealthbllc.com. If you want to know how you can optimize your income for retirement, potentially pay less on taxes, feel free to reach out. Thanks so much, and I'll see you next time.